Well, Mark Lackey is joining us, Executive VP, CHF Capital Markets. And Mark, I have said $1,250 on gold. I actually think a little bit lower.
Well, Pat, at one point you had said even 1,200, and the way things were going with this U.S. dollar in the last few weeks, it looked like you were going to be correct pretty quickly. I've been saying 1,300 at the end of this year, 1,400 next year. I did want to pull out my analysis, Pat, I did on forecasts, and I found 800 at the end of next year on the low end, 1,700.
$800 for gold?
Yeah.
Really?
I found, well, there's a few U.S. banks. I think Goldman's down at 800, if I'm not mistaken. 1,700 on the top end with the more bullish individuals. So you and I are not all that much different when you consider how wide the spread is. I had to go back to the late 70s to get forecasts that were this wide in terms of the spread. So I get people phoning me up as investors saying, who are we supposed to believe? I mean, this is such a wide gap. And I said, well, you know, people like me are kind of more in the middle. And that's where I will be here over the next year or two, certainly, unless the U.S. dollar continues to go through the roof, and that will put potentially more downward pressure on gold. But I do think there's some supply and demand issues here, Pat, and that's one of the reasons why I'm modestly bullish. Let's be honest, I'm not in the camp of the extremely bullish individuals, but I'm modestly bullish, and there are some reasons why I feel that way.
Well, the key drivers on a fundamental basis for demand are jewelry,
correct,
central banks,
correct,
and
the ETFs.
ETFs, right,
yep.
Exactly.
And if we look at those, that's interesting, Pat. Okay, the central banks are still buying more gold.
Yep.
The ETFs, the outflows...
Still, I'll point out that for a long time they didn't buy any gold.
They didn't.
So that's relatively new, yeah.
That is very new, Pat. For instance, I was a central banker years ago, and we weren't buying gold back in those days. And that was with the Bank of Canada. But now, in the last 4 or 5 years, that has changed. The ETFs, the outflows have slowed down to almost zero, so that's looking a lot better than it was. But you're right, the jewelry demand's been a problem, particularly in India. Why? Because India has, as you know, that import tax. Now, the new president says he's going to remove that over time. How fast he removes it, I guess, remains to be seen. I think some of it comes off in the next year, and that will help demand. But jewelry demand for gold is down 18% year over year. That's a big number, Pat, and I think that's one of the big reasons why gold's trading where it is, along with the fact that I didn't expect the U.S. dollar to be as strong as it is right now.
Okay. The other area you and I have talked about in the past is jewelry demand from China. Is that starting to appear? And
even there, Pat, it wasn't as strong as we'd hoped.
Yeah.
Not this year. I think that's more of a one-year phenomena. I do think we'll see more of a recovery in jewelry demand from China as we're going forward, but it seems like lately everybody's been concentrating on China because the numbers haven't been quite as strong as we anticipated. But I don't believe that all of a sudden there's going to be this rapid move away from gold in China. And I think the Indian situation to me is probably more critical in terms of the fact that the decline has been so significant given the import tariff.
Okay, the other thing you mentioned Bank of Canada. Many years ago, Bank of Canada didn't buy gold because they knew we had a lot of gold.
That's correct.
That's correct. They didn't use it as a currency swing.
No, that's correct.
What about the supply side of the equation?
And that's interesting, Pat, because here's what I think the $800 gold people have wrong when they think that's a sustainable price. There's, you know, a decent amount of gold today being produced at 900, 1,000, 1,100 an ounce. I mean, those people, I was in the mining business at one point, as you know. I mean, we weren't going to sit there and lose money. We might lose for a little while because you don't like to lay everybody off and shut down the mine. But you're not going to keep producing at a loss for any kind of time period. So I think 800 is unsustainable. Maybe 1,200 is sustainable, but not 800. So I think that on the supply side, even right now, we've seen some small shutdowns, but we're seeing people postponing projects, particularly a big one in the Philippines, a big one in Peru. And I'm hearing more and more companies, Barrick, I think, cut back on their corporate development group, for example. So they're not going to do nearly as much exploration. They're going to look maybe in acquisitions as opposed to exploration. So I think that we're going to see supply starting to slow down here because, you know, we're not at $1,900 like we were 2 years ago.
Yeah, Barrick is interesting, and they're not the only one. You know, there's all kinds of environmental problems and nationalism that are popping up that are stopping exploration from
absolutely,
happening.
Pat, and that's look, I'll be honest, Pat. Like, if you look at my models, I've had a lot of stocks that have dropped off my board because we're at 1,200 and 50 or 1,240. We're not at 1,900. So I'm out of the difficult jurisdictions. I'm out of the ones where there's environmental issues. I'm really now concentrated on good jurisdictions, good management, places where there's no environmental issues, places where they have agreements with the First Nations, so that all of these problems are behind us. But it's certainly cut down the number of people I'm following pretty dramatically.
Yeah, have input costs gone up? And I'm talking labor or the cost of steel, or, you know.
Yeah, in some areas more than others, Pat. Like, it's really expensive. I mean, welders can make up to $150,000 to $200,000 a year in Australia, for example. So, you know, there's a shortage of quality labor in Australia. It's really pushed up costs. Steel costs were rising. They've slowed down a little bit. But you're right.
Electricity, maybe?
Yeah, cost of
Power.
production. Well, Ontario is a good example of high power costs.
Yeah.
So, you know, all of these things play in, and you're right. It's a lot tougher to find guys that now are $700 or $800 all in than it was, say, 5-6 years ago.
Yeah. Okay, against that background then, you got 3 picks.
Right.
Phoenix Gold Resources.
Right, Pat, we mentioned this once before.
Yeah.
Phoenix is in Nevada. They have excellent property. They have an experienced management team, and they made it quite clear that their exit strategy is to get taken over. And I think that when you look at all the takeovers that have taken place in Nevada in the last few years, AUEX is one, for example, big guys have moved in and taken some people out, mid-caps have, and where they're physically located, they're surrounded by one major and a couple of mid-caps. So I have to feel that he's doing a lot of drilling right now, and it's his strategy. If he can get up to a certain level, then he knows he's going to definitely be a takeover candidate. And he's made it quite clear, so he's not going to end up with, say, a bid from somebody that's going to be viewed as a negative, because some people don't want to be taken out. And so this is definitely a takeover candidate. That's the way I would play this.
Who's the major that's around him? And then has he proven Newmont? That's a big name.
So Newmont, and he's done some drilling. Look, his property's quite interesting. I think the geology's straightforward, and he's got a lot of good Nevada people. He has to prove it up.
Yeah.
But he's getting there. So I would say over the next 6 months to a year, he's going to generate even more interest. And what happened in the AUX case was a mid-cap came in and took it, and then Newmont had to buy the mid-cap. So, you know, we'll see how this all transpires. But one of the big accounting firms has said to me they think Nevada is going to be one of the areas where the takeover activity is going to heat up.
Okay, Gold Eye Exploration.
Right. Now this is an interesting play, Pat, because everybody always tells me that when you get up to northwestern Ontario, Gold Eye, they're up in Sandy Lake, that's north of Red Lake. You know, Mark, all the gold's been found up in these places. You know, people have drilled and so forth. Well, this area hadn't been drilled all that much, and Gold Eye went in and got a deal with the First Nations. Oh. And now they did some drilling. And, you know, Blaine sent me his numbers, and I looked at them, and I was kind of, to be honest with you, quite surprised. I mean, he had 5 meters of about 12 grams, 4 meters of 8 grams. I mean, he had all these high-grade results. Now, I know it's the early first drilling approach, but with numbers of that grade, you know, Pat, good grade goes a long way in producing mines and getting you going forward. So he's now got a plan to do a lot more drilling, have a 43-101 probably next year. And so he's taken kind of an area that wasn't drilled all that much, but because he's a Northern Ontario geologist, geophysicist, he knew that there was some pretty good potential here. But to hit those kind of grades initially is quite remarkable.
Okay, and last one, Atlanta Gold.
Right, now Atlanta Gold, you'd probably think it'd be in Georgia, but actually it's in Idaho. And that's goes back to the days of the Confederacy, I guess. But the fact of the matter is, Atlanta Gold, he's come up with Ernie Simmons came up with a new recovery system. Why do I like this? Well, Pat, he's not going to use arsenic, he's not going to use cyanide, he's not going to use any of the
environmentally sensitive.
Exactly. He uses water. He's gone back to producing gold the old-fashioned way. And because he's come up with this way to do it, he's got other opportunities in the area. Now, the thing that hurt him this year was Atlanta, some of you know the floods were really bad in Idaho, state of emergency. He couldn't get the work done there. He went over to his other project and did work there. And I think Atlanta Gold will be a near-term producer. They should be in production next year, Pat. And I like the fact he's got a different recovery system, because now he can go to some other sites. He's not going to have to heat leach. He will be able to do things in an environmentally friendly manner, which, when we've had problems like we just recently had in BC, is on everybody's minds now.
As it ever. Mark, great to have you in. Thanks for coming in a day early.
Pat, always glad to be here.
Mark Lackey joining us, EVP of CHF Capital Markets.